Well, good afternoon, everyone, and welcome to the second session of the Grain Marketing for 2025 workshop. Just as a reminder, this is a live workshop, and you are in a regular meeting room, so we can hear and see you. So we encourage you to make sure that you are muted. And for right now, if you want to leave your cameras off, that's perfectly fine. But if at any point you would like to ask a question, you can turn on your camera, you can turn on your microphone, and interact with Cory or I. Today is kind of a fun workshop or a fun session because last time we were together, we got a question around basis. And so we thought that that would be a good opportunity for us to kind of dig back into grain marketing a little bit deeper and maybe go back to some basics, but also then take that topic of basis a little bit farther, maybe than you have heard other people go. So as we get started here today, as always, if you have any questions, you need anything, make sure you throw those in the chat and we will answer questions along the way. We can see the chat there as we're presenting. So to get started, as we talk about the topic of basis, we have to really kind of back a little bit farther up and talk about the futures market. So the futures market is an auction market in which participants trade standardized contracts. So this is as of last week. This is the corn futures market for the December contract for 2025. And where would you like to sell? You want to sell low or do you want to sell high, right? So this is what the futures market allows us to do, is based on the information of that day, sell grain for delivery in the future. And this contract has to be happens to be there for December.
In this space every day, and so find out who those people are.
So again, we can hear you if you are not muted. Please make sure that you are muted.
I've been muting as I find them.
Thank you. Thank you, Cory. All right. So just to recap that, a futures market is an auction market in which participants buy and sell standardized futures contracts. So again, here, what happens is everything about that contract is determined except for the price. So one thing that I think is difficult is that folks don't realize is that there are multiple delivery months being traded at once. So as we look at that, there's lots of contracts that are going on simultaneously. Now, we're also going to talk about the termination period, which happens to be the 15th, the business day prior to the 15th calendar day of the contract month. Now, that was a mouthful there, but let me show it to you in a visual here. So this dark black line represents us sitting here at the end of January of 2025. So as we move down, if I'm looking at soybeans, technically I could contract March, May, July, August, September, and November soybeans for 2025. Okay. Now, I may or may not have soybeans that I want to be trading on these contracts, but all of these contracts are open. Now, the termination is the last 2 weeks of that contract. Okay. So why is that important? Why is that termination or delivery period important? And that's because typically your local elevator will not allow you to contract during that delivery period. So those elevators, we call that rolling, will often go to the next month's or next available contract and not allow you to price when they're in that delivery period. Okay. So as we're starting to think about basis, we have to think about which futures market contract are they basing their price on. And so it could be multiple contracts that we are potentially looking at. So just to kind of help you think about this, if you haven't seen it before, sometimes you will see trading codes come up, and trading codes allow us to know what contract potentially your elevator is looking at. And I actually like to read these backwards, so I actually like to read from right to left. So if we start and the black numbers there, the two numbers on the end, that indicates the year of the futures market contract. The next letter, as we move again to the left, that middle number that is there in blue, or that middle letter, excuse me, that's there in blue, is the month of the contract, and then the first one or two letters is the commodity code. Okay. So you might see your elevator quoting utilizing these trading codes, or they might spell it out a little bit more there for you. So here are the commodity codes that are most common here in Nebraska. So corn, you'll see listed as ZC or simply C. Soybeans will be ZS or simply S. And then hard red winter wheat will be KE or KW. There are all the months there in that kind of second bullet point, but not every commodity uses a contract for every month. So soybeans trade 7 contracts per year. Corn and hard red winter wheat trade 5 contracts per year. So again, we kind of have to have this as we think about the basis as a whole. So getting a little bit deeper, your elevator might also call something new crop or old crop or nearby. So new crop indicates the contract that is closest to expiration at harvest. And this is the contract that we're watching if we're getting ready to market that crop for sale at or after harvest. So for example, right now we're watching the December corn contract because it is the contract closest to expiration during harvest. And that's the contract we're going to be delivering corn on as we bring in deliveries from harvest. Soybeans is November, winter wheat is usually July. Okay. Now they also might use what they call the nearby contract, which is the one that is currently closest to expiration. Okay. So let me show you an example of this. This is Cooperative Producers Inc. Out of Hastings, Nebraska. And what you can see here is the top, actually 3 here, quotes are old crop contracts. So if you look at this, they have delivery periods ending in January, February, and March. If you look at the basis month here, that's actually the futures market contract they are basing their cash price on. So they're basing all of these on the March contract, and you can see then the basis value that they are charging you for your delivery depending on when you want to deliver to their location in Hastings. So you can see if we're going to deliver before the end of January, we have a 40-cent under basis, but if we're willing to go to the end of February, they're only going to be charging us 37 cents under. Okay, so this is kind of an interesting layout, but as we get towards the bottom, you can see here the delivery ends October 31. We have a completely different basis value because it's based on a completely different contract. So that's on that new crop contract for 2025 with a 29-cent under basis. Okay. Now you might be sitting here saying, Jessica, why do I care about the futures market? I only market with my local elevator. And the reality is that the futures market is how your local elevator prices are determined. And therefore, we have to understand what's happening within that futures market. So even if I'm only selling to my local elevator, I'm not participating in any futures market trading or futures market contracts. When I sell to my local elevator, that local elevator is going to turn around and do things in the futures market that signifies what you are asking them to do in the cash market. Okay, so your actions, although maybe not directly feeding up to the futures market, in a roundabout way through your local elevator or through your local grain processor, are eventually coming up to the market. Okay, so we have arrived at basis. So what is basis? So basis is the difference between the cash price and the futures price. Okay, so basis is the difference between the cash price and the futures price. It represents the transportation and handling costs to move a product from one location to another. It also includes storage expenses, but it also might look at expected supply and demand. I live in Western Nebraska. I'm out at Scotts Bluff. The amount of cattle that we have in a feedlot might impact our basis. It can also look at the supply and demand of transportation services. This is especially true in the winter wheat market. So when there are few grain carts to get that winter wheat transported, we can see that the expense of that transportation really does impact then the basis value. We can also look at other things like variations in grade of the product. And then the last one there might confuse some folks. I use the term unavailability of substitutes. So the perfect example of that is if I'm a feed yard and I'm buying grain from local farmers and I'm used to a corn-based diet, can I switch from a corn-based diet to a winter wheat-based diet? No. It's difficult for me to do that. Another example would be going, if you're a corn-based ethanol facility, can you switch that out for another product to create ethanol? No. So what happens there is when you require a specific input like corn, right, you're willing to pay maybe a little bit more because you can't swap out for something else. Okay, so that's what that substitute piece is about. Now, basis is really fun. As an economist, I find it very fun to track because what happens is elevators may charge a different basis for each location or delivery period. So here's a good example of that. Hold on. So here's a good example of that. And unfortunately, this is back from July, but Frontier Co-op used to put out this grain bid sheet, which I think is kind of a fun example of this. So you would think that all of the locations potentially of Frontier Co-op would charge the same basis value. But as you look at this, here are all the locations, and it was a full page PDF that they had posted back in July. And you can see here, even from Adams to Avoca, they have changed that basis value. So if you look really closely, both of these are looking at the same contract, but the basis value here is very different, which results in a different cash price for each area. Okay. So even if you're looking at the same elevator in terms of it's the same company, the same cooperative, they might pay you to deliver to a different elevator, okay, by changing the basis values. Now, I'll be completely honest, I don't know how far apart Adams and Avoca are, but if there were two cities or two areas that were relatively close to each other, let's say you just happen to live in between them, then you as a farmer can make the choice. Do I want to go to location A or location B? Based on the price that they are offering. Okay. Now remember, they're determining it off the futures price, but charging a different basis at each location. Okay. So I've used some terms here that I want to take a step back and make sure that we define for you. And some folks will switch these up and maybe use the wrong term to define basis. So I want to be really clear about this. So we will say that basis is under when the cash price is less than the futures price. Okay. So when the cash price is lower than the futures price, so this is my cash price, it's lower than the futures price, that difference is negative, okay? And when the cash price is higher than the futures price, the basis value is positive. Okay. So if we go back to our Frontier Co-op bid sheet here, you can see down in the bottom corner of each of these, down in the bottom left corner of each grid box, you can see this is -9 cents versus -25 cents. Okay, I don't think they have any positive basis in here from what I saw. So these are all a negative basis or an under basis. Okay. The other terms you might hear someone say is that the basis is strong or the basis is weak. And this has to do with our expectation around where we actually think basis should be versus where it actually is. So a strong basis is a higher or less negative basis than we expect. Okay. A higher or less negative basis than we expect. So for example, in Western Nebraska, I expect the basis in Scotts Bluff at my local elevator at harvest time to be around negative 45 cents, negative 0.45. Okay. If for some reason my basis happens to be negative 30 cents, so it's higher, it would be stronger than I expect, even though it's still a negative basis. So stronger than you expect, even though it's still negative. So a strong basis does not necessarily indicate a positive basis. It has to do with your expectation of where basis should be. So the opposite of that is if I want that or I expect that basis to be around negative 45 cents and it happens to be at negative 60 cents, that's a weak basis. So that means it's lower or more negative than expected. So be careful as you're describing basis, how you're utilizing these terms. When we talk about strong and weak, that has to do with our own personal expectation of where we think basis should be. If we're talking about over and under, then we're talking about a positive or negative basis. Okay. So again, over and under indicates whether it's positive or negative. Stronger or weaker indicates where it's at relative to our expectation. So futures price and basis are two components of that, determining that cash price, and they're separate. They are separate. So futures prices and basis can move separately from one another. Okay. So as we think of this, usually they move opposite of one another, but it's not an equal relationship. It's not a one for one, right? But as futures prices go up, usually we see that basis become lower. So that's typical, but remember we have these moments where there are rare or extreme events where they can move together. And the drought of 2012 was one of those moments where we saw this moment where basis was coming up as prices came up, right? Because we were short on corn. There wasn't enough corn in the system or expectation for enough corn in the US. And so we saw elevators moving that basis value higher. So a lot of people, when they chart futures and basis, they chart it like you see here on the screen. And this is from this past summer again. So from July of 2024, this is a soybean contract. It shows, it's a good illustration of the gap, right? The difference between the futures price and the basis price, but it doesn't really tell me a lot about the movement of how basis has changed relative to the futures market. So when I chart futures and basis, I actually like to separate them out and chart them separately. So as you're reading this slide, on the left-hand side, we have the futures price in dollars per bushel. And we've got the futures market that bounces around a lot there, right? Almost every second of every day, we've got that price that's changing for us. If you go to the right-hand axis, you have the basis in dollars per bushel being charted, and you can see that basis value for this Waverly, Iowa co-op is pretty solid until about May, and then it drops. Okay, and it only dropped 4 or 5 cents, right? And then it was flat again. So basis does not change as rapidly as futures prices do. Okay. And we can actually, when we go to our local elevator, we can actually set a contract for just the basis without setting the futures price. So we call this a basis contract. So what happens is, what we're sitting here thinking is, I really like where the basis value is currently at, and I'm afraid that that value is going to become smaller or even more negative than it currently is. So I want to protect against that risk. But I also think that the futures market's going to continue to rise. Okay. So if I'm sitting there and my expectation is I want to protect against that basis from falling, but I still want the opportunity for that futures price to rise, I can engage in what we call a basis contract with the local elevator. So what happens is I can go in and I can set a contract with them that says I'm going to price grain today at your current basis value, which means that as time goes on, the basis now cannot get any weaker because I've locked that in with you as the elevator. However, I'm going to let that futures price keep moving because I think it's going to move up. Okay. Your risk here is that maybe you locked in that basis and the basis actually comes and starts to strengthen and do better, right? So you might have lost a few cents there. The other risk here is that, let's say you expected the futures price to go up, but it doesn't, right? So you still have that futures risk until you lock in the other side of that contract, which is that futures contract. There are service fees associated with these kinds of contracts. Last time I looked, it was somewhere around a penny or two per bushel to do this. So you need to factor that into your ultimate price that you receive, is knowing that there could be a fee associated with it. And there might be additional fees if you decide to roll the contract to a later month. You are locked into a specific delivery location and a specific delivery time. And then there, of course, may be penalties if you cannot deliver the contracted bushels. This is a really interesting contract that I don't think a lot of producers necessarily know about or use, but it is available again. But we've got to be in a situation here where you know or have the expectation that you're worried about the basis going down, but want the opportunity for that futures market to continue to work higher. All right, so I'm going to hand it over to Cory here to talk about some historical basis information. And here you go, Cory.
Awesome. And could I use my PowerPoint? I made a couple changes to that. So it'll start off the same, but move a little bit.
Yep, you should be able to share as co-host.
Sweet. Let's go to that. All right. Excellent there, Jessica, discussing the concept of basis and how it fits in with futures, and at the end there, how it's a great tool to keep an eye on, because there are opportunities occasionally in the basis contracting world. What we have here is new crop corn basis from 19 to 23 for an elevator, a specific elevator, one delivery location. And so that we start this off on March 1st, meaning we're just sometime in the spring, and they're giving, as Jessica showed in that one slide at the very bottom, they're giving that new crop basis contract. We're doing March 1st because that's when the crop insurance projected price is set. First thing you can see out of this is oftentimes elevators are very flat on changes. They just maintain certain areas for quite a while. And each year that basis number is different. And Jessica explained very well of why basis can change. year over year or at any moment in time. And what you typically see is you'll see a little changes as we get closer to harvest. And then typically around harvest, you start to see a lot of action because there's a lot of information entering the market. So buyers are responding to that information appropriately. And you can see sometimes here, like in 2022, basis can get really high. It really moved a lot here. But in other years, you know, it didn't move nearly as much here, like in 2019. So there's a lot of variability around basis. If you look at the variability here, it is really hard to find any remote strategy about, is the offer I'm getting any good? Okay, because of the changes. So the process then becomes, well, is there something maybe structurally that happens every year that I can take advantage of to identify whether my basis for my current year is good or bad? And that's taking a long run view of basis. And so what we have here is the average of those exact 5 years, okay, of basis bids, new crop basis bids. And as you see, it as a market for that one plant, which is an E plant, it drops down a little bit and then slowly makes its way up, and then it seems to peak somewhere here around right before harvest. Okay, one would want to draw the conclusions that, well, all right, I can play this game. I'm going to wait until right here to set basis. I'm going to wait till somewhere here in this time because it is the highest basis. Well, that's tough to understand or to lay your hat on 5 years, because when we add more years into it, 2012 forward, so we do have the drought in here, this exact same place, okay? We're running around 2012 because we're in the ethanol industry is fairly well developed, and so we're in the modern side of grain marketing experience we've had. So we have quite a few more years, and more years is good, especially over just 1 year or last year, right? That strategy of last year's more deadly than any other strategy I can possibly think of. In this case, at this ethanol plant, the optimal time on a long run seasonality strategy would be somewhere around August, in this range, or maybe even go anywhere from late June to early August. You're somewhere in here to lock in that basis. Now that's really easily said. It is much more difficult to lock in basis around here because this is when all the birds start chirping about there's a drought, price is going to go up, something's going to happen to your crop. So it takes a really clear-cut, well-developed strategy to make these decisions in here. And perhaps the best way to do it is to do it on a percent of your bushels. You know, don't be locking everything in. Okay, so this is the long run, what we could see in basis. This is the shorter run, the last 5 years. And this is any given year of what basis did. So if you wanted to run back to the previous year, I don't have 14 in here. If we wanted to run back to 23, the answer would be never do anything. It doesn't change. It's not any good. Okay. Or I can go back to 22 and say, man, I made a killing here. I'm going to wait for that again. Okay, those are very specific outcomes in years with very specific attributes to those years. I am not saying, though, that this one or the last 5 years is correct, or this one here with more years is any more correct. What I'm saying is watch for a certain time period of when that basis tends to get quite a bit higher than what it normally is. There will be opportunity somewhere in here in that basis bid because those elevators are trying to incentivize you to sign a contract so that then they know what they can be doing. They have more information about how much of rail cars should they be ordering, that sort of stuff. Maybe got a good purchase order in, and they want to capitalize on that. Okay, so they want to acquire bushels for that. Okay, so that's what you should be looking for, is somewhere in here. Now, that's an ethanol plant. We go to not very far away from this ethanol plant. We go to a non-ethanol plant, and we look at their long run historical basis, new crop basis, exact same thing. Okay, it's not very far away. By the way, Jessica, I think your 2 locations there of Adams to somewhere else was like 48 miles-ish. In this case, they're telling you, look, really wait until you get somewhere up in here, okay, to be considering locking in those basis contracts. All right, or to be waiting for them. Now, in our data, we only get the stated basis contract. In reality, you want to have a good working relationship with your local merchandiser, and perhaps you may receive a phone call when there is a good basis opportunities, because they may reach out directly. It may never even be stated, okay, and offer you a good number. And you need to know whether that number you get is higher or lower, as Jessica said, than that long run average basis. That's your benchmark. So if in the long run, the average of this whole thing here is minus 25 under, and you're being offered 10 under, that's a good deal, okay? That's a good deal. All right, here's an ethanol plant and a non-ethanol plant close to each other. Let's go to another ethanol plant and non-ethanol plant also close to each other. Completely different, okay? Completely different. And this is why you have to track your elevators that you deliver to. You gotta go to their basis, okay? And select the one with the highest. Again, that's a broad brush statement. The nuances of this, though, come down to, let's say you got 2 elevators close to each other. One of them's offering a better basis, but you have to sit in line for an hour to get dumped, and the other one, it's 10 minutes. And you're turning and you're going back. And the basis difference is only 10 cents. Well, I get it. I may be inclined to go to the one with the lower basis because I can keep things moving, okay? Get things off the field. Here's another ethanol plant, non-ethanol plant, and these two are very, very well related. You can see when it's low, it's low. And when it's higher, it's higher, okay? These two here happen to be from a very large player in the ethanol industry here in Nebraska. So we can understand why they may be highly related. Where this guy here is from a much smaller ethanol plant, but still very relevant ethanol plant. And this guy here is more of a medium size, okay? So while there's an ethanol plant in here, the ethanol plant's not necessarily the important part. The important part is that even another elevator nearby that's doing something completely different, it's just a regular demand location, a regular elevator, basis is acting differently. A basis is acting differently. So you need to find out what's going on in both of them and deliver to when they offer opportunities, or take advantage of contracts to deliver at harvest when there's opportunities. So again, to wrap this up, follow each delivery locations you use to understand the tendencies of those bases. Try to get a long run average. Don't be jaded by just last year, and engage in those contracts when they're favorable over past experience, and understand that information changes. You're gonna sign contracts again on hopefully a percent of your bushels, and some years those contracts are going to work out well. In other years, they're not going to work out as well. It's whether you're ahead in the long run, you only get to see that in the long run, but as you're going through this in real time, take the average of the ones you win, that you gain. I don't want to call it, I called it win, but it's you gain and you lose, and add that up and see how you're doing, and use that as your metric, not the metric of, well, I signed that basis contract and it worked against me, so I'll never do that again. Or the alternative is, I signed that basis contract, I should have done more of that. Well, yeah, but no. You want to balance your portfolio of what's going into your cash price and use that to your advantage. And with that, that is all I have.
Great. So again, if you have any questions, I have allowed you to unmute yourselves again, but you're welcome to also put them in the chat. So I do have a question in the chat, Cory. I'm going to read it, and we can play this game here. Let me do that so that we're both on the screen there. Do all elevators post the basis on their website, and do they create a chart? Or does the producer need to be doing this on a daily basis themselves? Mary, that's a great question. So, no, not all elevators share data the same way. And that's something that is somewhat frustrating to me as someone who teaches. I wish there was a consistent way that I could say, yes, you can go here and you can look at it and it should all be there. That being said, the bulk of them are using a platform called Bar Chart to show and design their websites at this point. It will show the current year's basis, but it does not show the historical basis. And so the best way to do that is what Cory was saying, is to actually get a pen and paper out or an Excel file and start tracking either what that basis price is or what the futures price and what the cash price is, and calculating out the basis on it. And maybe it's not every day, right? Basis isn't as dynamic as the futures price, but maybe it's every week that you pull that data or that information to help you start to establish what that expectation for each of those local elevators in your area that you're willing to deliver to can do. And remember that it's not just elevators. Again, as we come farther west, or if we go into the northeast where there's a lot of feed yards, that could be feed yards, that can be ethanol facilities, whatever that location happens to be. If they are buying grain, it wouldn't hurt to start taking the time to write down that basis information so that you kind of have an established idea of when certain locations are offering different basis values and what you can expect from each location. Cory, anything to add to that?
No, that's perfect, especially when starting out. That's the place to be. And once you get a little intuition behind it, then you'll know right away when you see it. This is odd enough, but so I get emails from CHS back home giving bids, which happened to just stop today. They're switching over, I think, to bushel from DTN. What I used to do was I would just search in my email the local elevator, and I'd get all their bids over time, and I would just scan through those really quickly to see how basis had been moving, getting worse, getting better, and that would lean me one way or the other, which way I wanted to go. And that's really back of the envelope, but I'm pretty comfortable with it. But I'm also very respectful that, spring wheat prices on basis have a tendency to move a lot. So it can get pretty wild. So I don't have big expectations, but there's certain times of the year I like to look at those more than others. And I definitely, in the June timeframe, July, I call and I ask what the new crop is, because they don't post it. The data you saw earlier was just the elevators that had new crop basis bids. We have a ton of elevators that have zero new crop basis bids. They don't post it, at least in the data source we got. So a lot of it comes down to calling.
The other thing I will say with that is make sure that you're matching the proper futures contract to the proper cash bid if they're not denoting what that is, especially if you get close to a delivery period, because they might actually be big. Again, they might have rolled that contract. And so they're actually basing it on the basis on the next contract. So become friendly with your local grain merchandiser to some extent. If you don't have the information you need, I see no problem reaching out and saying, hey, what contract are you basing the current today's cash bid on, especially when we're close to that delivery period. So we've got some more questions coming in through the chat. Again, please continue to put them in. The next question is, do you see more of an advantage to loading basis contract or just loading a cash price order throughout the year, or is it basically the same thing? Just tracking the price instead of the basis amount. So Cory, we'll let you start out on that one.
Yeah, that's a great question. That's a balance of comfort level and knowledge. So your cash, when you're setting that cash, you're essentially saying both futures and basis is reasonable to you to take advantage of that. You could separate those two things and say, all right, I think, seasonality on futures is great right now, but I really don't like the basis bid. They seem to be under, 10, 15, 20 cents of average. And in that case, you would lock in futures and then you would wait for that basis to hopefully improve. And then you would lock that in, giving you both your futures and basis so you have a cash position then. That is routinely the side I hang out on, is that, and that is just through many years of experience. But I will absolutely, when they're both good, futures and basis, I will lock them in, done, cash, it's over with. So I ebb and flow between them, but when I'm on pre-harvest, they are, by default, they're separate for me until I see a good basis, because I may want to do something now where that basis, as we just showed, is typically bad, and I want to get closer to harvest and find out what the market's offering to me. And I don't always win in that. That's not a bulletproof strategy, but I do have gains over time. And I've got to know the merchandiser better because of it. And they've been more pleasant with me because I'm trying to manage my position positively, actively, and versus I think the bulk that people that come in there complain. And it's literally down to they don't understand the tools they have and the markets they face. And so that's been interesting. But I do complain to them about when they don't offer new crop contracts. I'm always trying to get them to offer the new crop contract price on their bids. And then they remind me that, Cory, you're the only one doing this in our group. So I'm a solo duck. I don't get enough weight. So.
And for those of you who are sitting here as advisors, I think it's, if you're a banker or you're an insurance agent, or you happen to be a merchandiser, it's just reminding those producers of the tools that are at their fingertips that they can use, making sure those producers understand exactly what they are getting into when they engage in that tool, and making sure that they're not overextending themselves in terms of not only just contracting too many bushels, but also making sure that they're not contradicting the types of contracts that they already have on the books. Okay, so another question is, I have a basis contract for white corn that is 60 cents over the July 2025 bid for yellow corn. Why is it over the asking price? So this is interesting, where you have white corn, which does not have a futures contract, and you have yellow corn, which does. So Cory, you want to take a little stab at why would the basis be 60 cents over on the white corn?
Yeah, you bet. So you got the futures over there on yellow corn, and you have a cash price that's over there on the white corn. And there's apparently something really fascinating happening in white corn. They're offering a huge premium. So something good happening. And it's literally not over, it's not that it's 60 over the new crop or the futures price. It's where it's at relative to its historical average. I couldn't tell you if white corn is normally 40 over and it's now 60, so there's really a 20 cent gain, or if it's normally 80 and it's at 60, so there's a 20 cent deduction right now. I don't know. But you're literally got two different markets right there, and they're radically different.
The other thing I would think about is what are the substitutes for white corn and what are we using white corn for, right? If you're using it for corn chips, you can't really substitute white corn for yellow corn in that situation. So there's lots of dynamics that are in play with that. So it looks like we are out of questions for the moment in the chat. I will give a call. Again, I believe that you can unmute yourself if you prefer that method. To unmute yourself, that button is down there in the bottom left of your screen. You can unmute and ask a question, or you can place a question in the chat, and Cory and I can answer that. So we'll give you just a few more seconds to get any final questions in for us today. Just in case someone is quickly typing, to let you know our next session will be on February 11th. Again, remember we're going every other week. And on February 11th, we will be discussing cost of production and how it plays into a marketing plan and marketing strategy. Okay. Question just came in. Are there central newsletters available that describe the trends across areas like a weekly email newsletter? So Sophia, this is such a great question. USDA actually used to do what I would call more regional basis reporting or price reporting, and they've stopped doing that in a way that's allows us to look at maybe a larger area trend. That being said, I still think it's really important for you to actually get in to your local elevator or to your local grain buyer and start tracking that individual elevator. Like Cory showed, even if we look at a broader area, like I can tell you the Scottsbluff area is traditionally an under, and it's around 40 to 45 cents under at harvest, but individual locations have various patterns within them. So if you don't have this historical data for your area, you might go into your elevator and ask, hey, can I get 4 or 5 years of, Friday cash prices, and go start to match that all back together and kind of build that historical trend for those individual areas. Cory, anything to add on that?
No, that's exactly it. While it is reasonable to have a general idea of what's going on in an area, there may be something really good happening at your local elevator, and you may miss it that way.
So another question is, when you say basis is positive, you mean that it is small in terms of amount? No, so remember, that means that the cash price is higher than my futures price. When the basis is positive, the cash price is higher than the futures price. Okay. All right, so again, if you have any more questions, Cory and I are happy to hang out. We've got about 10 more minutes on the calendar. If you want to stay and answer those, we will stay and answer those questions. We do ask that if you don't mind, if you would fill out the evaluation that just popped up on your screen. That helps Cory and I know how we are doing. So if you would go ahead and fill out the poll that was just launched, it should pop up 3 simple questions there for you, and we'll continue to take questions out of the chat.
And in a month, Jessica, we're talking about crop insurance.
Yeah, so looking ahead, like I said, on February 11th, we're going to be looking at cost of production and how that integrates into our grain marketing strategy. On February 25th, yep, we're gonna dive into crop insurance and some of the crop insurance options that are out there. And then our final session will be on seasonality of pricing.